Welcome students, welcome to lecture number 37, where we will be beginning with module number 6, which is minimum alternative tax, which is also called as MAT, under subject direct taxation. Now, module number 6, which is minimum alternative tax, it is also called as MAT. M stands for minimum, A alternative, and T tax. Now, as per VTU syllabus, it covers how to compute the taxable income of a company with special reference to MAT and problems on MAT. So, module 6 is a very small unit. So, only if you know the concept of MAT and you have problems on MAT. Let us move ahead. So today we will be covering how to compute the taxable income of a company with special reference to MAT, and if time permits, we'll also be solving problems on MAT. So before we try to understand how to compute MAT, let us first understand what is the meaning of MAT. What is MAT actually stands for? Where is MAT applicable? How to compute, how to calculate MAT, and what is MAT credit. So before we go to computation of the income of a company with reference to MAT, let us first understand the basic concepts of MAT. So students, remember, MAT is covered under section 115 JB of income tax. MAT is nothing but the minimum alternative tax which is payable under the Income Tax Act. Now pay attention, students. Why was MAT introduced? Many a times what companies used to do, when I'm talking about companies, it is corporate entities. Okay, students, it does not cover individual, it does not cover HUF, it does not cover partnership, purely corporate entities, that is companies. So when companies used to pay tax, in order to avoid paying tax as per the total income, that they have to pay the income tax on the total income, they used to show excess dividend paid to the shareholders. They used to show certain exemptions, deductions, and they would then pay very less tax. Just by showing certain exemptions, deductions, showing more dividends to the shareholders, they would end up paying less tax to the government. So government didn't want that companies should do all this and pay less tax to the government. So government introduced the concept of MAT. So let me read the second sentence. The concept of MAT was introduced to target those companies. When I say companies, that means MAT is applicable only to companies that make huge profits and pay the dividend to their shareholders, but pay no tax or minimal tax under the normal provisions of Income Tax Act by taking the advantage of various deductions, exemptions allowed under the Act. So to avoid, this problem of the companies paying lesser tax or no tax, so the government introduced MAT for the companies. Now, next, with the introduction of MAT, the companies have to pay a fixed percentage of their profits as minimum alternative tax. So MAT is applicable to all the companies, including a foreign company. So under MAT, what is happening? Under MAT, every company has to pay a fixed percentage of their profit as a tax to the government. And this fixed percentage of their profit is called as a minimum alternative tax. Now, what is that fixed percentage and what is the profit? That we will be seeing in the succeeding slides. So I hope you'll have understood the background of what is MAT. First of all, MAT is nothing but minimum alternative tax, which is covered under section 115 JB of the Companies Act. First thing. Second thing, MAT was introduced only to make sure that the companies don't end up paying lesser tax or no tax. And under MAT, the companies are supposed to pay fixed percentage on their profit as a minimum tax to the government. And MAT is applicable to all the companies, including foreign companies. Now, students, Let us see the MAT applicability. To whom all does it apply? MAT is applicable to companies, domestic as well as foreign companies. MAT is levied on all corporate entities, foreign companies with Indian income source. So in short, already in my previous slide, as I told you all, MAT is applicable to only companies. Though individuals, HUFs, partnership firm, etc. are excluded from the applicability of MAT, they are now subject to alternative minimum tax under section 115 JC. So students, 115 JB is applicable to companies, which is MAT, and 115 JC, that is AMT, alternative minimum tax. It is applicable to everyone exception companies. So this is not there. AMT is not there for your syllabus, but just you'll need to know that in case of individuals, HUF, partnership firm, MAT is not applicable, AMT is applicable. Income from charitable activities are excluded under MAT. Companies dealing with infrastructure, power sectors, insurance are also excluded. So those companies who are dealing in infrastructure, power generation facilities, insurance companies are excluded from the MAT applicability. So from this particular slide, we conclude that MAT is applicable to only companies. See students, we know that the company is divided into a domestic company and a foreign company. Now what is a domestic company? A domestic company, as you all know, is an Indian company, okay? Or a company which is made arrangement for declaring dividends out of the income which is chargeable to tax in India. So it falls under the definition of a domestic company. And what is a foreign company? A company which is not a domestic company becomes a foreign company. So MAT is applicable only to companies. Next, how to calculate MAT? Now, remember students, MAT is equal to 15% of book profits. So, MAT, you all know, is nothing but a fixed percentage on profits. Now, in my first slide, I told you it is a fixed percentage on profits. What is a fixed percentage? 15% of which profits? Book profits. Now, how to calculate book profit? We will be seeing 15% remains fixed for the assessment year 2020-2021. Students, for the earlier assessment year, the fixed percentage was 18.5. From the assessment year 2020-2021, which is applicable to you people, your batch, so that rate is 15%. Earlier to this assessment year 2019-2020, it was 18.5%. But from the assessment year 2020-2021, MAT is equal to 15% of book profits plus surcharge and cess as applicable. See, we know that surcharge is nothing but a tax on tax, and cess will obviously be applicable in all the situations, and MAT is applicable only to companies. So what is the surcharge rate of companies? We have already seen in module 1, but just I'll be revising now. Surcharge, if applicable. Now surcharge is 7% for domestic company and 2% for foreign companies where the total income exceeds 1 crore but does not exceed 10 crore. And it is 12% for domestic company and 5% for foreign company where the total income exceeds 10 crores. So after adding surcharge, you have to add health and education cess at the rate of 4% shall be added on the aggregate of income tax and surcharge. So how do you calculate MAT? MAT is equal to 15% of book profits. Now, you all know what is 15% is fixed. Now let us know how to calculate this book profit. So book profit is nothing but it means the net profit as shown in the profit and loss account for the year as increased and decreased by some items. Students, how do you calculate book profit? Book profit is nothing but the net profit that you have to pick up from the P&L account, but you have to do certain additions to the net profit, certain deletions to the net profit, then you will arrive at the book profit. Now let us see what are the additions and deletions that you have to make to the book profit, to the net profit, in order to arrive at the book profit. So students, till here, have you all understood what is MAT, to whom it is applicable, and how to calculate MAT?
Yes, ma'am.
Yes, students?
Yes, ma'am.
Everyone got it? Okay. Now let us move ahead in calculation of computing the book profits. So how do you compute book profits? You take first the net profit from the P&L account, add and less some items. Now let us see what are the items to be added to the net profit and what are the items to be deducted from the net profit. First, look at your left hand side. Additions to net profit if debited to P&L account. So only if the below items are debited to P&L account, you have to add it back to the net profit. When do you debit things to P&L account, students? When there are expenses, correct? Debit side of the P&L account shows all your expenses. Credit side shows all your incomes, correct? So if the below items are debited to P&L account, you have to add back those to the net profit to arrive at the book profit. So what is the first thing that you have to add back? Income tax paid or payable. Students, if income tax is paid or payable, or even if there is a provision for income tax, you have to add it back to the net profit. Now, what all income tax includes, students? Income tax may include your surcharge, your health and education cess, if there is a dividend distribution cess. Why I'm telling dividend distribution tax? Because again, it is a company. So don't think about individual now in this module. Just think about a company. So company pays dividend distribution tax since it pays dividend to the shareholders. So income tax paid or payable, in this, what all is covered? The dividend distribution tax also is covered. Surcharge also is covered. Cess is covered. Cess is nothing but health and education cess. Interest, whatever it is paying on income tax, that also is covered. So if all these expenses are debited to P&L account, please add it back to the net profit. Next, amount transfer made to any reserve or amount carried to any reserve. So if any transfer of the profits is made to any reserves, please add it back to the net profit. The reserves can be called by any name. So just remember, if any transfer of amount is made to any kind of reserve, please add it back to the net profit. Next, dividend proposed or paid. So whatever amount of dividend the company is paying or proposing to pay, and such amount is debited to P&L account, please add it back to the net profit. Next, provision for loss of subsidiary companies. If any provision is made on the debit side of the P&L account relating to a loss of a subsidiary company, please add it back to the net profit in order to derive at the book profit. Next, depreciation, including depreciation on account of revaluation of assets. So if there is any depreciation, that amount of depreciation has to be added back. And if depreciation includes any depreciation on account of revaluation of assets, that also is supposed to be added back. Next, amount of provision of deferred tax. So suppose deferred tax is tax that you're not going to pay immediately, you're going to postpone the payment of it. So if there is any deferred tax amount, or if you're making any provision for deferred tax, that has to be added back. Next, provision for unascertained liability. For example, provision of bad debts. So any provision that you're making for unascertained liability, okay, provision is nothing but, as you all know, amount set aside to for meeting liabilities, okay, other than ascertained liabilities. If it is ascertained liability, you know that the amount of liability is certain, it is going to occur, and if you're making provision for that, it should not be added back. But if it is a provision for unascertained liability, you have to add it back. And provision is nothing but amount set aside. for meeting that particular liability. Next, amount of expense relating to exempt income. So when any expense is relating to an exempt income, okay, that has to be added back. Now, when I say exempt income, that means incomes under section 10, which we have seen under module number 1. So whatever exempt income, like suppose agricultural income is an exempt income. So whatever expenditures relating to the exempt income is debited to P&L account, you please add it back to the net profit. Next, provision made for diminution in the value of any asset. So suppose if any asset, the value is decreasing, and if you're making the provision for it, provision means if you're keeping aside any amount to make sure that since the value of the asset is decreased and you're making sure to fulfill that decrease uh, by making a provision of it, that also should be added back. Amount standing in the revaluation reserve. So we know that the profit shall be increased, okay, by the amount standing in the revaluation reserve relating to the revalued asset on the retirement or disposal of such asset. So students, if any amount is standing in the revaluation reserve and it is debited to the P&L account, please add it back to the net profit. Next, amounts of gain arise on transfer units of business trust. So suppose if any units of business trust are transferred and any gain is arising, it has to be added back to the book profit. Okay, it has to be added back to the net profit in order to compute the book profit. Next, notional loss on units of business trust. So if there is any notional loss on the units of business trust, that has to be added back to the net profit. It can be maybe notional loss on the transfer of a capital asset. Notional loss may be in the change in the amount of the unit, or loss on transfer of such units. If there is, then you have to add it back to the net profit. So students, these are some fixed items. Okay, there are some fixed items which you'll need to remember, that what is to be added to the net profit. So is this clear, students? Once you add, and in every sum, each and every item will not be given. Few of this will be given. So make sure you add it back to the net profit in order to derive at the book profit. So is the left hand side clear, students? In short, what you'll need to remember is income tax, whatever you're paying, any transfer to any reserves, dividend on any kind of provision which is for unascertained liability, depreciation. Okay, these are usually asked items, and amount of expenses that is relating to exempt income. So as we solve problems, you all can even remember what has to be added to the net profit. So is this clear, students? Is the left hand side clear? Yes, students?
Yes, ma'am. Yes, ma'am.
Okay, now let us see now at the first instant, it will not be easy for you all to remember, but as we solve problems, you all will be able to remember. Next, deletions to net profit. When I say deletions to net profits, means the profit shall be reduced by the following amounts. By the amounts that you all can see on the right hand side, the net profit has to be reduced. Okay, only if these items are credited to the P&L account. So first one, amount withdrawn from any reserve. So if the amount is withdrawn from any reserve or maybe any provision, and if such amount has been credited to the P&L account, it has to be reduced from the net profit. Exempt income. Exempt income, again, the income which is covered under section 10, 11, 12, which we have seen in unit number 1. If they are credited to the P&L account, please reduce it from the net profit. Next, amount withdrawn from the revaluation reserve. If this has been credited to the P&L account, okay, to the extent that it does not exceed the amount of depreciation on revaluation of the asset, this you all will understand better when we solve the problems. So if it is credited to P&L account, then reduce it from the net profit. Then brought forward losses and brought forward and unabsorbed depreciation. So any depreciation which is brought forward from the next previous year and unabsorbed depreciation is brought forward, you are supposed to reduce it from the net profit. Next, deferred tax. Next, depreciation, share of an SSC in the income of an AOP or BOI if it is given on the income side, because we want to know what is the book profit of the company, right? So if any share of the income, share of the SSC is there in the income of AOP or BOI, you're going to reduce it from the net profit. Income accruing to foreign company, you're going to reduce it. Notional gain on the units of business trust, loss on share of units, income by the way of royalty, and profits of sick industrial company. So if all these are credited to P&L account, please reduce it from the net profit. These are fixed set of list which you have supposed to add it to the net profit or delete it from the net profit, provided they are debited to P&L account and credited to P&L account respectively. So students have well understood how to compute the book profit. Book profit is nothing but net profit after adding and deleting certain items from the net profit. And MAT is nothing but 15% of book profit. So whatever book profit you arrive at, you have to take 15% of that book profit. Okay, you will get MAT, and then suppose if surcharge is applicable, add surcharge, and you have to add health and education cess. Then you will get the total minimum tax to be paid as per MAT provisions, that is as per 100 and section 115 JB. Is this clear, students? We will understand this particular slide properly when we start solving the problems. So is this clear, students?
Yes, ma'am.
Okay. Next, what is MAT credit? So when any amount of tax is paid as per MAT by the company, then it can claim the credit of such tax paid in accordance with the provisions of section 115 JAA. The section number you need not remember. Okay, students, one thing I want to know from you all. Okay, MAT is applicable to all the companies. Agreed? Yes. Now MAT was imposed or was brought into picture because companies used to pay lesser tax or no tax as per Income Tax Act, whatever they had to pay. Third thing, tell me, students, now suppose as per Income Tax Act, as per Income Tax Act, that is as per the calculation, if they have to pay more tax and MAT is showing a lesser tax, what tax would government want? Income tax, like the tax to be paid by the companies as per the normal provisions of income tax, or the tax to be paid under MAT provisions? Which tax would the government want? Whichever, by the calculation of whichever method gives you the maximum tax to the government will want that tax, right? So under MAT, what is happening is government is saying, the provisions are saying that calculate the income tax as per the normal provisions of income tax. Normal provisions means we have seen under module number 3, income from business or profession of a company, how to calculate. Okay, how do you calculate the income under normal provisions of income tax? You take the income from the business and profession, capital gains, other sources, you add that, you apply normal slab rates. In case of companies, the slab rates are different. It is 30% flat or 25%. You add surcharge, you add cess. So that becomes calculation as per normal provisions of income tax. And you calculate the tax to be paid by the company under MAT. So under MAT, how do you calculate the tax? 15% of book profit. The government is saying a company should calculate tax under both the methods, and whichever method is giving the highest tax to be paid, okay, that amount has to be paid to the government. So is this clear, students? Now obviously it is common sense, government will either, if the normal provisions of income tax is giving them more tax when compared as calculated by MAT, so they will want the tax as payable by the normal provisions of income tax. So students, see here, allowable tax credit. Tax paid as per the MAT calculation minus income tax payable under normal provisions of Income Tax Act 1961. So what is a credit? Whenever you are getting a sum on MAT, what you have to do is first calculate the tax to be paid by a company as per the normal provisions of Income Tax Act, which you all know how to calculate. Next, calculate the tax payable by a company as per the MAT provisions. MAT provision says that it is 15% of book profit. Then compare both the taxes. Whichever tax is higher, that is going to be the tax payable by the company. Now, suppose if the tax payable by the company as per MAT is higher than the tax paid under normal provisions of Income Tax Act, then the difference amount will be treated as a MAT credit. And such credit shall be carried forward for 15 assessment years, immediately succeeding the assessment year in which credit has become allowable. So, is MAT credit clear, students? Yes?
Yes, ma'am.
To make it much clearer, we will see an example. Pay attention here, students. ABC Limited has a taxable income as per the normal provision of income tax of 40 lakhs. So we know that as per normal provisions of income tax, we calculate taxable income. How do we calculate taxable income? We have already studied about it. You take all the heads of income, you get the gross total income, you minus the deductions, you get the taxable income. So that becomes as per the normal provisions of income tax. And book profits it has of 95 lakhs for the, this is assessment year, students, sorry for the error, for the assessment year 2020-2021. Okay, now they are telling what should be the tax to be paid by ABC Limited. So what is going to be your first step? First step is you're going to calculate the tax to be paid, okay, as per the normal provisions of income tax. And tax payable by ABC Limited will be the higher of the following two. First, rupees 40 lakhs, that is as per the normal provisions of Income Tax Act, you're going to calculate 40 lakhs at the rate of 30%. We know that for companies, the normal slab rates do not apply. The slab rates are applicable for individual. For company, it is flat 30% or flat 25%. So rupees 40 lakhs is his taxable income on that 30% plus 4% is 4% is the cess. Your surcharge will not be applicable. Reason being, the income is not exceeding 1 crore. Surcharge is applicable for companies when their income, gross income is exceeding 1 crore. So 40 lakhs into 30% plus 4% health and education cess. So tax payable as per the normal provisions of income tax is 12,48,000. Now tax liability as per MAT provisions. What you have to take? Book profit is how much? 95 lakhs. So 95 lakhs into 15%, because as per MAT, how is the calculation? 15% of book profits plus you're going to add surcharge and cess if applicable. So surcharge is not applicable since it does not exceed 1 crore. Plus 4% health and education cess is applicable in all the cases. So you get 14,82,000. So as per normal provisions of income tax, you are supposed to pay 12,48,000. And as per MAT, minimum alternative tax, you are supposed to pay 14,82,000. So hence, what should be the tax to be paid by ABC Limited to the government, students? Higher of both. So which is higher, as per MAT provisions or as per the normal provisions of Income Tax Act? Which is
MAT
higher?
provision. MAT provisions, ma'am.
So hence tax payable by the company will be 14 lakh 82,000. Now MAT credit will come into picture only when the income the company has paid tax as per MAT. So what will be the MAT credit? Tax paid as per MAT minus tax to be payable as per the normal income tax. So the difference will be the credit which can be carried forward for a period of 15 assessment years. So 14 lakh 82,000 and 12 lakh 48,000 is equal to 2 lakh 34,000, and this 2 lakh 34,000 is nothing but the MAT credit. So I hope everyone has understood what is the meaning of MAT credit. Now suppose if it was a reverse picture, suppose as per MAT provision it was 12 lakh 48,000 and as per normal provisions of Income Tax Act it is 14 lakh 82,000. Then what would you do? You would pay 14 lakh 82,000, but MAT credit would not come into picture because you are paying tax as per the normal provisions of income tax and not MAT. So MAT credit will come into picture only when you're paying tax to the government, okay, as per the calculations of MAT provisions. So is this example clear, students? Yes?
Yes, ma'am.
Yes, ma'am.
Okay, so now can anyone tell me if any sum is given that calculate the taxable income or the tax to be paid by a company? Okay, what are the steps you're going to follow? With reference to MAT, what are the steps you're going to follow? Step number 1 is you're going to calculate the income tax payable as per the normal provisions of income tax. Step number 2, you're going to calculate the tax to be payable as per MAT. Step number 3, you're going to compare the tax payable as per the normal provisions of income tax and tax payable as per MAT. Step number 4, whichever is higher, you are going to pay that amount of tax to the government. So these are the steps which you need to follow even while solving the problems, okay, in order to know what is the amount of tax to be paid to the government in respect of companies. So let us see the computation of taxable income of a company with special reference to MAT. So MAT is calculated under section 115 JB of Income Tax Act. Every company should pay higher of the tax calculated under the following two provisions. Provision number 1 is tax liability as per the normal provisions of Income Tax Act. Tax rate is, for in case of companies, it is 30% plus 4% education cess plus surcharge only if applicable. Tax liability as per the normal provisions of Income Tax Act, whose turnover or gross receipt of rupees 250 crore during the financial year 16-17, tax rate is 25%. So you have to apply 25% tax rate in case of companies where the gross receipts was 250 crores in the assessment year, in the financial year 16-17. Whoever's gross receipts were 250 crores or less, you have to apply a tax rate of 25% on those companies plus 4% education cess plus surcharge if applicable. So your first step is to calculate the tax liability as per normal provisions of income tax. Second step is calculate the tax liability as per the MAT provisions, okay, which is given under section 115 JB. That is 15% of book profit plus 4% education cess plus surcharge if applicable. So surcharge, first you have to add surcharge, then education cess, but surcharge if only if applicable and education cess in all the given situations. So students have well understood how to compute the taxable income of a company with special reference to MAT. Is this particular slide clear? Because based on this slide, we will be seeing the problems. Is this clear, students?
Yes, ma'am.
Yes, ma'am.
Yes? Okay. Now let us see problems on MAT. See students, first of all, how to calculate the taxable income. See, first, in order to charge tax, we need to know the taxable income as per normal provisions. Book profit, we know how to do. Now, how to calculate the uh, income from the business in respect of companies, we have seen in module number 3. You take the net profit as per P&L account. You add back all the expenses that are not allowable, and you minus all the incomes which are to be charged under other head. Then you get income from business. To that you add income from capital gains, income from other sources. You get your gross total income, you minus the deductions, you get your taxable income. On that taxable income, you will charge 30% or 25% as the case may be. Surcharge and health and education says you will get income as per the normal provisions of income tax. So let us start. A domestic company, ABC Limited, furnishes the following particulars in respect of assessment year 2020-2021 and seeks your opinion on the application of section 115 JB. So if in your exam it comes section 115 JB, you all have to remember it is a section relating to MAT. You are also required to compute the total income and taxable income of ABC Limited. So let us see based on this information. Profits as per the statement of P&L account as per the Companies Act is 215. So the net profit as per P&L account is 215. Statement of P&L account includes these credits. Dividend income from Indian company 20 lakh. Excess realized on the sale of land held as investment 30 lakh. Now students, forget MAT. First step is to calculate the tax as per normal provisions of income tax. How do we calculate? First, you take net profit as per P&L account 215. You will less those credits you will less those incomes which had to be taxed under other source of other head of income. See, in this business income, you will take only those incomes which are business incomes. But suppose if any income is relating to other head of income, you are going to minus it. Are you all remembering module number 3? Income from profits and gains from business and profession? Yes, students? Yes?
Yes, ma'am.
So from 215, you will minus 20 lakhs. 20 lakhs was added to the P&L account. Why are you going to minus it? Because dividend income is not an income from business or profession. It is an income from other sources. Then excess realized on sale of land held as investment. So this becomes, this 30 lakhs also you are going to minus. Why? Because if it is an investment, it becomes income from capital gains. Is this clear? Why you are going to less these two items from your net profit? We are going to see the book profit right now. First step we are going to see is the total income as per the normal provisions of income tax. Next, debit side you have depreciation on straight line method basis 100 lakhs. Is this an allowable expense, students? Tell me, students. Depreciation was debited to the P&L account. Is it an allowable expense for the business or disallowed? See, any depreciation as per the income tax rules, depreciation on the reducing balance method or depreciation as per the income tax rules is allowable. But on straight line method basis, it is disallowed. So if it is disallowed, it will be deducted from the net profit. So depreciation on straight line basis, you have to add it back to the net profit. Next, provision for loss of subsidiary company. I told you already that any provision, okay, if it is debited to the P&L account, you have to add it back, even in calculating the normal income as per normal provisions of Income Tax Act. Next, depreciation allowable as per the income tax rule. Now, this is a depreciation that is allowable, but this was not debited to P&L account. So now you are going to minus this allowable expense from your net profit of 215 lakhs. Is this clear, students? Next, short-term capital gains on the sale of land mentioned above as computed as per the normal, as per the Income Tax Act. Now, short-term capital gains, under which head of income is this going to come, students? Directly, short-term capital gains is given. In which head of income is this particular thing going to come?
Income from capital gains.
From head capital gains. Very good. Next, losses brought forward as per the books of accounts. So you have two losses. One is business loss, which is carried forward, and unabsorbed depreciation, which is carried forward. Now we have seen that under set off and carry forward of losses, that business loss which is carry forward or unabsorbed loss depreciation which is carried forward, you have to deduct it depending on the income that you have or no. You have to set it off, okay, whichever is less. So now let us first understand how to calculate the income as per the normal provisions of Income Tax Act. This is a revision for you all, but calculation as per MAT will be a new thing for you all. So let us start. In case of a company, it has been provided that where tax on 15% of book profit exceeds tax on total income computed as per normal provisions, the book profit will be deemed to be the total income for tax purpose. That we know. Now, computation of total income as per the normal, as per the Income Tax Act 1961. So how do we calculate? First, you take net profit as per the P&L account, that is 215. Next, you add back all those expenses which are disallowed. So add back depreciation debited to the statement of P&L account, because this depreciation is on straight line method basis and it is not as per the normal provisions of Income Tax Act. So you add back depreciation 100, provision for loss of subsidiary company 60. So 160 you add it back, you get 375. Next, you less those incomes that are to be considered under other head, not under this particular business head. So dividend income, it is exempt income. So you have to exclude it 20. So you're minusing it. Excess realized on sale of land, it is to be considered separately, students. So 30. And depreciation allowable as per Income Tax Act, it is an allowable expense. Therefore, you have to deduct it from the net profit. So 120. So what is your business income, students? Your business income will be 175. Now in set off and carry forward, we have seen that business income can be set off, business losses can be set off against business income. And we know that the brought forward loss, business loss is 50 lakhs. So less set off of brought forward business loss 50 lakhs. You get 125 as the net business income. From that, you will, after that, you will take income from the head capital gains, which is 40. So total comes to 165. Dividend income comes under income from other sources, but since it is exempt, it will again be nil. Less set off of unabsorbed depreciation. After setting off everything, then unabsorbed depreciation has to be set off. This we have seen in set off and carry forward of losses. Less set off of unabsorbed depreciation 60. You get total income as per the Income Tax Act 1961 as 105. Is this clear, students? This we have just computed as per the normal provisions of Income Tax Act. Is this clear, students?
Yes, ma'am.
Are you remembering this? We have done this sums. In exception set of sums, we have done the normal thing under module number 3. Yes? Okay, so today we will conclude only up to here because we are falling short of time and this sum is little big. Because now after this, we have calculated the total income as per the normal provisions of income tax. Now we have to calculate the book profit. Then we have to calculate tax on the normal provision of income tax and tax on the book profit. Whichever is higher is the tax to be paid by ABC Limited. So have you all understood how to compute tax as per the normal provisions of Income Tax Act for this particular problem. Yes, students?
Yes, ma'am.
Yes,
Okay,
ma'am.
students, can you all tell me? Okay, can you all tell me what is the tax to be applied on this 105 income? What is the tax to be applied as per the normal provision of Income Tax Act? See, the turnover of ABC Limited for the previous year 2016-17 was 240 crores. So what is the percentage you will apply?
25%.
Very good. You will apply 25% tax. Then you will get tax as per the normal provisions of income tax. In our tomorrow's lecture, we are going to see how to calculate income as per MAT. That is nothing but 15% of book profit. So we conclude for today. Thank you so much.